Hello, everyone, and welcome to our webinar on income averaging. I am Sarah Campbell. I'm USDA's Beginning Farmer and Rancher Coordinator, and I help manage our Ag Tax Education Asset Protection Initiative. USDA has partnered with tax experts, and we have a suite of tax-related resources, recorded webinars, fact sheets, and informational materials available on farmers.gov/taxes. So those are, we encourage folks to explore those resources, check that out. But I'm going to hand it over to Adam in just a moment here to get started. So we have Adam Kantrovich from Clemson here with us today. He's one of our tax experts, and he's going to be talking about income averaging. Excited to see you all here. If you've got questions, please put them in the chat box. We'll have time for Q&A at the end. Also, as just a little housekeeping note, this webinar is being recorded, and the slides and the recording will be posted on farmers.gov/taxes. It usually just takes us a couple of weeks to get all of that processed and online. So bear with us, have patience, but the recording and the resources referenced during this presentation will be available online. Also, if folks are here because they have IRA payments, I think this income averaging might be particularly relevant to folks who have received some financial assistance regarding their farm loans. If you've kind of gotten a recent large payment from FSA lately. Also, if you're not sure what I'm talking about, but you have an FSA loan, I encourage you to also visit farmers.gov. We do have a December 31st program deadline where folks who have loans who are financially distressed can apply for assistance with those loans. So please visit farmers.gov, explore there, see if maybe that might be right for you. But without further ado, I'm going to hand it over to Adam. Oh, he looks like maybe he just got kicked out of here. Oh, Adam, you're back.
Right. I am back. I apologize. I don't know what's going on, but I am going to make sure that I get onto a stable connection here. I hope.
Looks like Adam might be having some technology issues, so we'll give him a moment to sort through those. But again, folks, if you got questions, put them in the Q&A box, and we will.
All right. So hopefully, Sarah, can you hear me? And Janet, can you hear me? Okay.
Yes, we can hear you. We can't see your slides yet, but we can hear you.
Okay. Let me do those slides. Let's try this again. All right. Are you able to see the slides?
Yes.
All right.
You're good.
Okay. So hopefully this will work for us. I am Adam Kantrovich. I am an extension specialist with Clemson University. I co-chair a committee known as the National Farm Income Tax Extension Committee with my co-chair, Dr. Ruby Ward out of Utah State. And we have been working with the USDA Farm Service Agency, Sarah and Janet, on a contract working with tax education for farmers, tax professionals, and others, and also in the area of asset protection. And this is part of that work. And we want to inform everybody that you must understand that when we talk about these types of topics, in particular tax issues, in Internal Revenue Code, etc., you must understand that things can change at any moment. And some people have a hard time understanding that. Why can they change? Well, unfortunately, we have very little control over Congress, and especially nowadays. And Congress can take action, change laws in a blink of an eye for all practical purposes. We can also receive outcomes from court cases which may change interpretation of some of that code or how we have to work through Internal Revenue Code, as well as further guidance that may come about through the IRS. And so please just remember that. And all the information today is coming from ruraltax.org, which is part of the Farm Income Tax Extension Committee, the Internal Revenue Service, and the Lagudiff Land Grant University Tax Ed Foundation. So we're going to talk about tax management. And not a lot of people like talking about taxes in general. However, it's one of those things in life that we know we can count on. We know time is going to continue to march on. We know at some point in time, everybody's going to have to pay the piper, and we are going to die. Taxes are just part of this particular process. And tax management is not how to get out of paying taxes. If that is your idea of tax management strategies, typically we have found you will end up paying more in tax liability over the long haul versus following what really tax management should be, which is how to get as much money through the tax system at the lowest effective tax rate possible. So, how do we do this? This is done through multiple methods of tax management. So, one, every individual that is farming or has a business, agribusiness related or not, ought to meet with your tax professional with about 6 to 8 weeks remaining in the tax year. And the reason why I say in that tax year is it is possible to have a tax year that may not be associated with a calendar year. So your business may be following a fiscal year that might run December 1 to the end of November, or October 1 to September 30th, etc. And so you really want to meet with your tax professional 6 to 8 weeks prior to the end of that fiscal or tax year and begin to figure out where are we from a revenue standpoint, where are we from a expense standpoint, how much do I have revenue yet to come in this year, how much more in expenses do I have to take this year. Are there any capital assets that I'm selling that still have to be sold before the end of this year, and or purchases that I'm going to be making? And then we begin to take a look at various aspects of Internal Revenue Code to determine what are some management strategies that we can utilize within the Internal Revenue Code to potentially decrease my tax liability over the long haul. So typically we begin to look at some things that are pretty traditional. Are there any net operating losses that might be available for me to use from carryover losses from previous years? If I still have some potential inputs to purchase for the coming year to be able to make sure that I've locked in a supply of something, or because I know I can get a discount on it today versus waiting. Is there a potential that a product may not be available at the time of need, so I need to lock it in now? That might allow me to deal with some prepays that will obviously potentially create an additional expense to lower my taxable income this year. There may be some different depreciation methods that I might make use of on some of my capital asset purchases if I made some or I'm going to make some before the end of the year. Then, of course, our pre-tax retirement investment type accounts, medical accounts as well that I might utilize to help offset some potential tax liability. And last but not least is income averaging. Income averaging does not necessarily have to be decided upon before the end of the fiscal/tax year. This is something that can be done at following the conclusion of that year. And that's where we're going to hone in today. These simple bullets that I have here are just a few of the items that are typically considered as part of this tax management process. That being said, please understand that in many cases when I have worked with farms, we have actually wanted to increase and make sure that we've taken in some additional revenue this year just to be able to maximize some other parts of our system. Yes, that may have increased the amount of overall taxes that I've paid, but I may have been able to overall reduce my effective tax rate by making more use or maximizing other deductions, credits, that I may not have been able to maximize without that additional income. So let's hone in on income averaging. Income averaging was added as part of Internal Revenue Code back in 1997. It is still underutilized. It has been underutilized for the last 20 some years. A 2004 study showed an average savings of $4,434 of tax liability by 50,800 farmers that were looked at from their records. That was representative of about a 23% savings in tax liability. And others have looked at this maybe less thoroughly more recently in the last 5-8 years or so. And we have found very similar outcomes when we take a look at other farms. That a savings of, on average, annually of $3,500 to about $5,000 in tax liability if we utilize income averaging. And so it's important that we really have these discussions with our tax professionals. Some tax professionals just don't feel very comfortable with regards to income averaging. Income averaging can only be used by certain groups of individuals. In particular, our farmers are one of those groups of individuals that can utilize income averaging. And so in general, tax professionals just don't have quite as much experience with utilization of income averaging. But really what's happening is it's averaging the tax rates that apply to a current year farm income using tax brackets from previous years. And so really what we're doing is taking a look at, I'm going to take income from this year and I might just use lower income tax rates that were unused from previous years. But there's very specific rules that have to be followed. One of the other reasons why some tax professionals may have a fear of income averaging is because the software that they are using, some software is better than others at taking a look at income averaging and finding the right exact dollar amount to maximize our tax liability savings through the use of income averaging. So it's also important to understand that income averaging is not the same as amending a return. And so when I income average, I am not amending a return. And so I am not opening up that return to be looked at from an audit standpoint. I'm not resetting that clock. Now, that being said, I can amend returns for up to 3 years. And if I have not used income averaging in the past, I could amend a return from 3 years ago and then income average that income backwards. And so we'll talk a little bit more about this here in a few moments. The next question we usually get is what happens if I'm a landlord and we're utilizing crop share? Does that count and can that be utilized for income averaging? Crop share landlords may qualify for income averaging, but it is not a guarantee. A written agreement and timing of that agreement are absolutely crucial to determine whether or not a crop share landlord may also utilize income averaging. The written agreement must be signed before the tenant begins significant activities on the property. So what that means is if you decide just on a handshake to let your neighbor begin to utilize your property and there's no written agreement with regards to that, and they have already put inputs in, they've planted the ground, very well potential, if ever audited, the IRS may say, sorry, you as a crop share landlord are ineligible because that written agreement was not signed and was not in effect prior to planting taking place. So it's important to have that written agreement, having it signed before any significant activities begin on that property. Okay. That being said, the landlord does not necessarily have to materially participate for the income if it is a share of that crop. All right. to be able to be counted, to be able to be used for income averaging purposes. But it is also important to understand a fixed cash rent is not prop share, and that does not qualify to be used as part of income averaging. That is simply rent. So let's start talking about certain definitions that pop up when we talk about income averaging. One is the election year, the year of the election. Then we have something known as the base years. So if I'm a farmer and I'm just completing my 2023 year and we've had a really good year in comparison to 2022, 2021, and 2020. My election year may very well be 2023 and 2022, 2021, and 2020. Then we have something known as electable farm income. This is the income that is potentially allowed to be utilized in some fashion that may be considered for income averaging purposes. It has to be reduced first by any net operating losses that may be utilized. It's going to include any income that has been brought in from the sale of farm assets, with the exception of land, and may include as well, all right, S Corp shareholder wages that had to have been paid. So for most of us, we're not going to worry about that. We're going to let the tax software that our tax professional uses to figure those things out. Okay. Then we're going to have the actual elected farm income, and that is the amount taxed at base year rates. What does that mean? All right, that means I'm taking X dollar value from this year and I'm going to apply that to my base year's tax rates. That is what's known as my elected farm income. This is going to make a lot more sense here in a slide or two. My farming business is a trader business that is considered a farm for income averaging purposes under Internal Revenue Code section 263A, little e, number 4. Okay, there are some very specific rules with understand that only farm income counts for income averaging, and so it's quite possible, depending on your structure, the income that you might have, not all of that income might be able to be average. And so we really need to work with a tax professional. So income averaging is filed on what's known as Schedule J. It allows taxpayers to utilize those unused hopefully lower tax rate brackets from previous 3 years. Only farm income qualifies. It does not affect taxable income. It does not affect self-employment income, nor does it affect SE taxes. All right, none of that will change overall. Your taxable income remains the same. Your self-employment income does not change. The amount of self-employment tax owed does not change. The only thing this does affect is what tax rate is utilized to determine the income tax that has to be paid. So this is a chart that I've developed to hopefully make it a little bit easier for everybody to understand how income averaging works. And so we're going to use, as an example, the 2022 tax year and a base years of 2021, 2020, and 2019. In this example, we can see that I have income of $110,000 in 2022. Now, for 2022, based on those income tax brackets, that income is above the 12% income tax bracket and into the 22% income tax bracket by a total of $26,450. Okay? And so what we are going to do, we take a look backwards into 2021, 2020, and 2019. In 2021, we had income that was at $70,000. All right. But in 2021, the top of the 12% tax bracket is just over 81,000. So I have a window of about $11,050 in there of 12% that can be utilized. Then if I take a look at 2020, my income was only $65,000. So the top of that 12% bracket was $80,250. All right. So that's just over $15,000 there of 12% that can be used that was not used in 2020. And then in 2019, we had taxable income of $72,000. The top of the 12% tax bracket in 2019 is $78,950. Now, just for a reminder for everybody, our income tax brackets, along with a number of other limitations, change from year to year based on a rate of inflation. The IRS makes those determinations and changes usually sometime in the late fall to early spring of the new tax year. And so we already know in 2023, we already know what our tax brackets right now are going to be for 2024. So when we take a look at all of this, we're going to go ahead and we're going to take $30,000 from our 2022 income. Now, Internal Revenue Code says that for income averaging, we have to understand what our electable income is, and that's this 110,000. Okay, I can elect income from there to be able to utilize my income tax brackets in the base years. And these base years are 2021, 2020, and 2019. My election year is going to be 2022. So I'm going to take $30,000 of that 110, which will lower that 110,000. 110 minus 30 is 80,000. So that's going to bring that down. Okay. And what does that mean? I'm going to be back down with a couple $1,000s left over, left in the 12% income tax bracket. And under Internal Revenue Code, you can't just put down, $10,000 in one base year, 15 in another, etc. I have to elect a certain dollar value out of my election year. You have to equally divide that number by 3. And each of those equal thirds is applied to each of the previous 3 years, those base years. So if I choose 30,000 divided by 3 equals $10,000. And so we are going to take 10,000 from 2022 and apply it to 70,000, okay, in that 2021 year, which brings me up to 80,000. Leaves me $1,050 left in the 12% tax bracket without going over. 10,000 gets applied to 2020. 10,000 gets applied to 72,000. Okay. Now, real simple math here. That's $30,000. What did I just save in income taxes? I went from taking 30,000 that was in the 22% income tax bracket and applied 12% income tax brackets from those base years to it. That's a savings of 10%. I just saved $3,000 in tax liability that I did not have to pay to the Internal Revenue Service at the federal level. Okay? That is the basics of income averaging. That is how this works. Okay? Now, just to show you a couple of different things here, another couple of examples, part 1, and we're going to have a part 2. This could have been using the income averaging, but this could also use other methods of tax management. Joe Jones is married, filing joint return, and has a standard deduction of $27,700. Net farm income is $125,000, but my taxable income is $97,300. Now, utilizing the income tax brackets, etc., federal income tax that's owed is just over $12,000. Self-employment tax that is owed is $19,125 for a total of $31,146. The marginal tax rate, meaning the income tax bracket that we are in because of the taxable income, is 22%. Okay? But when I average what I'm actually paying based off of that 125,000 and the taxable income of 97.3, I'm actually have an effective tax rate of 9.6%. I'm not including the self-employment tax here of that extra 19. That's a little bit different, okay? And so my effective tax rate is 9.6% when we're not looking or considering that self-employment tax. Now, we go ahead, we utilize some other methods for tax management strategies, and this is another chart that we are looking at here. And off to the left, our income tax rate. Okay, this is my tax rate. Down here is my taxable income in thousands. Now, we can take a look here. Right about this 91,000, you can see a big jump in my income tax. That's a change in bracket where I go from 12% to 22%. And it kind of hangs out here until it goes up to, just under 25. It continues to go up and up as we continue moving off to the right. My self-employment tax, or sometimes known as SE tax, is just over 15%, about 15.3%. And that is actually made up of two different parts. One is Medicaid and the other, Medicare, Medicaid, and the other is Social Security. Okay. But you only have to pay Social Security on the first X amount of dollars of income. All right. And so, and this year it's actually gone up, it's going to go up to about 168. It's going to come all the way over here and then drop. And so this was done early on for 2023. And so we can see right here, all of a sudden, once I reach here, I've maximized and don't have to pay that 12 point some odd percent to Social Security anymore. And so it actually begins to drop off. Okay, and this green line here is the combined between my income tax and the self-employment tax. So we can see how this goes up. And so really what we want to do when we're following some management strategies, do I need to bring in some additional income so I can get us all the way over to this side of the hump? All right, and effectively push income over there. So then I've maximized and no longer have to pay that over 12% towards Social Security. Or can I somehow reduce my income to get it to end over here before I make the jump into that 22%? Okay, into that tax rate. So that's the basic idea. So we're going to go ahead and we're going to utilize a few different things for tax management strategies. Same basic idea. This time we're going to purchase some additional inputs because we're receiving a discount on it. My net farm income now is going to drop by an additional 20,000. My taxable income is now dropped. My federal income taxes has dropped. My self-employment tax has also dropped in this scenario. So my total tax has dropped to just under 25,000. That is a tax savings of $6,245. My marginal tax rate is 12%. My effective tax rate is now 8.4%. And we haven't even used income averaging yet. Okay. And so in this case, since we've moved everything to 12%, technically we may not need to use income averaging. However, in many cases with many farms that we work with, we may still want to utilize income averaging to just push some of that income further back into those previous base years to help build holes now, so that next year and the year after and the year after, if my income increases, because I have a good year, or I have fruit trees that haven't matured yet, but they will be maturing, so I expect higher yields, or I know I'm taking over another chunk of ground that's coming up, in a year or so, and I'm going to start planting that. And so I'm going to be increasing my production. And so I know I'm going to have more income. And so I want to build those holes so I can push that income in the next couple of years into this year. And so we may still want to utilize income averaging. So income averaging should still be considered, even if it will not necessarily provide an immediate benefit in the current year. But what I'm doing is building myself a larger hole to be able to use these lower tax rates in future years. It can create opportunities for that income. It will move that income to prior years for lower base years in the future. You might want to even consider, if we haven't used this in the past, and I know because I'm looking at and planning for additional income in the coming years, we may want to talk about, is it of value to amend my last 3 years of taxes and be able to utilize income averaging in those previous 3 years to keep pushing income back to the previous 3 years. So if I amend a return from 3 years ago and then income average that, I've literally pushed, and I'm using income tax brackets from 6 years ago and creating those holes. Okay. So every third year, that full base year drops off. So if I go back and we take a look at the chart here in 2022, this is our election year, but now in 2023, I don't have access to 2019, okay? For 2023 year, my base years are going to be 2022, 2021, and 2020. And in 2024, my base years are going to be 2023, 2022, and 2021, and 2020 drops off. That's how this kind of works, and it just continues to roll forward. And with that, this was a short program for today, our final one of the year. Here are some references and resources. IRS Publication 225 Farmer Tax Guide is always a wonderful resource. Please visit Rural Tax website, ruraltax.org. And of course, the USDA farmers.gov website, farmers.gov/taxes, for previous webinars, additional links to other publications and other information. And I'm more than willing to take a few questions this afternoon. Here's my contact info. Janet, Sarah.
Yep, you've got a few in the queue. One question was about the type of eligible entity for income averaging. Could it be any type of entity, or including sole proprietorship?
So sole proprietor, sole proprietor, our partnership. So this does not necessarily take place at the entity level. It takes place at the individual level. So you're not going to see a C Corp making use of this necessarily. So what flows through to us?
And then the other question, kind of similar, I think it might just be a semantics question, but was, can ranchers use income averaging?
Yes.
Or okay.
And so you have to be a qualified farmer, and only farm income counts. All right. So rental income that might be coming into the farm for renting a chunk of ground to a neighbor, that's rental income. That's not farm income. So that income has to be removed and can't be used. But, income that I have received from selling my feeder cattle, guess what? That counts. That is farm income. All right. If I'm a qualified farmer and I have farm income from the raising of agricultural products, all right, and crops, that's farm income, and you're able to utilize income averaging.
Those are the two that were in the queue. If folks have other questions, please drop them in the chat.
Hopefully this wasn't too confusing. It can get quite confusing. Hopefully that little chart or table or graphic is able to help provide a little bit more insight to understand how this works. It's a relatively simple concept. The tax professionals kind of have to watch and ask a few questions there as it relates to making sure that the income that is being utilized is eligible and that you meet the definitions for a qualified farmer. And so there's a question that came up: are the income numbers on the graph after all expenses are deducted? So the income that is used, it is not our gross income. It is our income, gross income minus our deductible expenses gives us our taxable income. That is the income that we are able to utilize for income averaging. So hopefully that explains it, Karen. It's not gross, it is our net, which is revenue minus expenses. Advice for finding a tax professional. So we did a webinar. My counterpart, as part of the committee, did a webinar. I believe it was back in August on how to find a good tax professional. And at ruraltax.org, and I believe it can be found on farmers.gov/taxes, is a publication on how to find a tax and legal professional. Karen, if you still have questions with that in regards to that, please reach out, send me an email, tell me what state you are in. I will try to find an individual like me or somebody within cooperative extension or counterpart that might be able to find a list or somebody for you in your state or region that might be able to reach out. Okay. Does sale of cows for breeding count since it is taxed as capital gains? So, Catherine, that's an interesting question, and you have to be careful. Does sale of cows for breeding count? There may be a little bit of a misunderstanding with regards to cows being sold for breeding purposes. If I have a milking cow, or if I have a beef cow that I am using that gets bred for the purposes of producing calves, that is capital asset and that is capital gains. All right. That sale will be taken into consideration as capital asset sales for averaging purposes. However, if I am raising breeding livestock because of their genetics and I am selling those for others to use to breed, those are not capital assets. What is being sold is not a capital asset. If I sell it to a neighbor who's buying it for its genetics, for them to breed or to milk, etc., actually that sale is not a capital gain to me. That is actually ordinary earned income. So we have to be really careful on some of those things. Okay, but in general, all of that is going to be considered and maybe taken in. But again, facts and circumstances are going to have to be looked at. And so it's a depends type question, and we really want to make sure that I understand all the facts and circumstances surrounding the question you are asking before I give a definitive yes. Does that include exotic animals? No, not necessarily. And so we got to there's a lot of facts and circumstances to the exotic animals. And so farming activities, raising of dogs does not count. Kennels don't count. There's a lot of things that don't count. And so we need to be careful on that. And I would have to look up in some other cases to see if that would qualify. And in many cases, it may not qualify. So I'm planning to lease land owned by federal agency, use as radioactive website for planting feedstocks for renewable energy project for use as fuels for transportation. My question is, the income derived from renewable feedstock is income subject to income averaging? I'd want to look at the facts and circumstances, but my knee-jerk reaction typically is crops that are typically raised for food, fiber, and energy typically are going to be considered um, agricultural crops and farming activities. Okay. We may want to talk a little bit further to find out exactly what types of crops we're talking about, and may need to do a little bit further digging if there's some odd things in there that I'm not thinking about. But typically, raising of things like sorghum, scanthus, corn, and those other types are still agricultural products. Regardless of how they get used following that, you're selling the raw product, which is a agricultural commodity or product. So there shouldn't typically be an issue, but again, I'm always going to put that asterisk that we may need to see additional questions.
Well, it looks like we've cleared the queue for now. But folks, have your contact information if something comes up after the fact. And yeah, as Adam mentioned, there's a bunch of other resources on farmers.gov/taxes, including a fact sheet on choosing a tax preparer. We've got a couple different webinars that talk about the topic, but one specifically, a little kind of mini webinar on choosing a tax professional. And it has a list of questions you can ask somebody you're considering to kind of get a sense of their experience with agriculture or kind of tolerance for risk, and just some of the other basics that will be important for you as you go to select a tax preparer. So with that, I would say thanks everybody for joining us. Thank you, Adam, for making time today. Oh, we've got one last question that came in.
We do have one last question. Is drought qualify as net operating loss, hence may be used as a deduction? That is a very interesting question. And so facts and circumstances are going to tell us that. So it does not automatically, a loss is going to be created when my expenses, I've got a higher deductible expenses than what I have for revenue. That creates a loss. Okay. And so if I lost 50% of my crop due to drought, I still technically could have a profit. And so, Edwin, you may want to contact me so we can maybe talk about this a little bit more. That being said, as well, there are some very specific rules that relates to having to sell potentially livestock because I don't have the grass or feed necessary due to drought or other types of environmental conditions that were created. So there's a lot of other potential tax benefits that might be of benefit to us during these types of situations. And in fact, we've got a couple of publications that you can find at farmers.gov/taxes or at ruraltax.org with regards to some of those things. And if I remember right, with one of those other questions, as Sarah said, a copy of the presentation will be put up onto farmers.gov along with this video. Is that correct, Sarah? And so it'll take a few weeks, probably sometime in January. I guess this will all be found up on the web shortly.
Wonderful. And there was one question about the treatment of basically USDA payments or insurance payouts.
That's going to be a maybe. A little bit more, because crop insurance, there's different types of crop insurance on how certain things get covered. And so, and then the government payments are not necessarily, I mean, it's a government payment. I'd be honest with you, for some reason, I need to look that one up. And so, I should know that, and I apologize that I do not know that one off the top of my head on a government payment. But again, drought payments, again, it's going to be very dependent upon process, and it depends on where this fits in. But many of these are going to be considered farm income or other farm income. So, but crop insurance gets a little bit tricky on a couple of things. And so I want to double check that before I give a final answer. All right. Thank you.
Thanks, Adam, and thanks everyone, and have a wonderful afternoon.